Welcome to the AgriAsia Commodities Podcast. I'm Daryl Kryst, Vice President of the Soft Agricultural Commodities Asia team at StoneX. This is your weekly cocoa update, where we break down the key developments shaping cocoa prices, from the expanding West African harvest and improving weather conditions, to the broader macro backdrop of a stronger US dollar, falling energy prices, and a shifting investor sentiment that's weighing on the entire soft commodity complex. Well, it's been another difficult week for cocoa markets. Prices extended their slide for an eighth straight week, with Ice London cocoa down about 1.8% to £4,155 per tonne, and New York cocoa off about 1.7% to $5,892 per tonne. Both contracts now trading near their lowest levels in almost 2 years. Since mid-August, New York cocoa has lost about 33%, while London is down 28%, making one of the sharpest corrections in the market's recent history. The trigger for the losses remains the same: a surge in supply out of West Africa as the new 2025-2026 main crop harvest gathers pace. Early arrivals in Côte d'Ivoire and Ghana have been larger and timelier than expected, reflecting favorable growing conditions and improving logistics. Well, the recent increase in farm gate prices in both countries has also encouraged farmers to accelerate deliveries to local cooperatives, front-loading supply into export channels much earlier than usual. At the same time, weather conditions have turned almost ideal, reinforcing the market's structural surplus narrative. Regular rainfall mixed with sunny intervals across major growing zones, including Subre, Daloa, and Amenguru, has supported strong pod development and healthy bean formation. BMI research described current field conditions as optimal for pod growth, suggesting this season's crop could easily surpass last year's production levels. Adding to that, field reports indicate fewer pests and disease issues compared with last year's mid-crop, while soil moisture reserves remain high, improving yield potential into November. Meanwhile, neighboring producers such as Cameroon and Nigeria are also reporting improved weather and strong harvest prospects, adding another layer to the global supply overhang. Combine these with West Africa origins account for about 70% of the global cocoa output. This means even modest yield improvements translate into significant additional tonnages for the market to absorb. Although the supply side of the equation looks overwhelmingly comfortable heading into the first quarter of 2026, and with no major weather or logistical disruptions in sight, traders expect steady export flows and continued downward pressure on futures until demand fundamentals start to turn. But while supply keeps growing, demand simply hasn't caught up. Dealers expect third quarter grind data, due later this week, to confirm year-on-year declines across Europe, North America, and Asia, highlighting just how fragile the consumption side of the market remains. Across the value chain, high retail chocolate prices and sticky inflation are weighing on consumer spending power. In Europe, cost of living pressures have promoted households to cut back on discretionary items like confectionery, while in the US, even the Halloween buying season, typically a peak period for chocolate sales, has been slower offtake compared to prior years. In Asia, processors are operating under narrower margins as energy and packaging costs stay quite elevated, leading to reduced grind utilization rates. Some manufacturers have turned to cheaper substitute blends or have trimmed product lines to manage their costs. Altogether, the demand picture points to a market still struggling with post-inflation fatigue, where retail prices have yet to meaningfully adjust downward, keeping chocolate demand soft even as raw cocoa supplies expand. Okay, so now let's take a step back and look at the bigger picture. Because the story in cocoa this week isn't just about harvests and weather. The macro backdrop has turned decisively against the soft complex. The US dollar has strengthened sharply over the past few weeks. putting pressure on all dollar-denominated commodities, from cocoa and coffee to sugar and cotton. For importers, that means higher local prices and weaker demand. For producers, particularly in emerging markets, it makes exports more profitable, encouraging even more supply to flow into the global system. In West Africa, the combination of a stronger US dollar and higher local farm gate price is proving to be a powerful mix. On one hand, it supports farmer incomes and encourages early deliveries to local cooperatives, but on the other, it's accelerating bean sales into an already oversupplied market, which continues to push cocoa futures lower. And this dynamic isn't isolated to cocoa. It's part of a broader macro shift rippling through the soft commodity complex. In coffee, a weaker Brazilian real has prompted exporters to ramp up shipments just as timely rainfall across Minas Gerais improves next year's crop outlook, adding to near-term supply pressure. In sugar, the recent plunge in crude oil prices has eroded ethanol margins, leading Brazilian mills to divert more cane toward sugar production, reinforcing the global surplus narrative. Meanwhile, in cotton, the stronger dollar is squeezing US export competitiveness, leading American fiber struggling to gain market share against cheaper origins. So while each market has its own local story, whether it's weather in West Africa, fuel economics in Brazil, or currency headwinds in the US, the underlying theme is remarkably consistent. Stronger producer currencies, improved production conditions, and subdued global demand are collectively reinforcing a structural surplus across the entire soft space. To sum it up, the cocoa market remains trapped between strong supply and soft demand, while macro headwinds, particularly the stronger dollar and risk-off sentiment in commodities, are amplifying the downside. The story this week is not just about cocoa's own fundamentals, but how global macro forces are reshaping the entire soft commodity complex. Well, that's all for this week's episode of the AgriAsia Commodities Podcast. I'm Daryl Kryst, Vice President of the Soft and Agricultural Commodities team here at StoneX. Thanks again for tuning in, and I'll be back next week with more insight into the global softs and agricultural markets. Until then, trade safe and stay informed. Till then.
This podcast is for informational purposes only and is not a recommendation to trade, an investment research, or an offer to buy or sell any financial product. It does not take into account your particular investment objectives, financial situation, or needs. The trading of financial products such as futures, options, or swaps involves a substantial amount of risk and may not be suitable for everyone. Past results are not indicative of future performance. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you.